Welcome to Do Different Better, where we talk about wealth wisdom and money moves, making finance simple for everyday people. I'm your host, Elaine Rasmussen, founder and CEO of Social Impact Now, Connect Up Institute, and general partner of the Integrated Capital Fund. Thank you for joining me today. In our last episode, we talked about charity versus change. And today we're going to be talking all about due diligence. We'll discuss what it entails, how long it takes, and why it's crucial when you're trying to access capital. And the lens of our conversation today will be mostly about accessing business capital or capital for your business. But I think some of the things that I'm going to be talking about today are going to be good in any situation, whether you're thinking about bringing on a partner, whether you're looking to buy a home. A lot of these things either happen somewhere in the background or in the foreground whenever you're trying to access capital, whether it be bank capital, private investment capital, private equity, venture capital, any of those things. These are going to be good things. And quite frankly, they're just going to be good business principles. But you'll also learn how to identify the gaps within your business that require your focus to navigate the due diligence process successfully. You're not going to want to miss this show. Tune in and we'll give you some really valuable insights. Trust me, you'll be glad you did. So let's go ahead and get started. What's due diligence and why does it matter? Due diligence is looking at everything about a company before deciding to give you money. The process includes learning about the company, the management team, reviewing the financials, looking at your products and services, and a lot more. Due diligence helps investors or people looking to give you money, bankers, feel confident in their decision to give you money. When you successfully get through the due diligence process, that means that you've confidently shown that you have a solid organization that's going to make good decisions, and as a result, you have been positioned for the company to deliver a return on investment that you have promised. Let's talk a little bit about the concept due diligence. It's not something that rolls off the tongue. It's not everyday language. People don't walk around like, "Hey, have you gone through a due diligence process?" But it is the language that you hear in certain rooms around the people making decisions around money. But basically, due diligence is a fancy word of saying, we're going to get into your business and we want to know all the things about your business to make us feel good about giving you this money. That's essentially what it breaks down to. But let's really talk about the concept of due diligence. Due diligence is about understanding what you're getting yourself into. And I think that's good on both sides, whether you're the investor or whether you're the investee, particularly in relation to valuation of the business and evaluation of the business. The mainstream expression of due diligence dates back to the Securities Act of 1933, not too long after the 1929 crash, which provided a liability defense for broker dealers who did a reasonable investigation before recommending a stock, right? So if you remember back to the crash, people were making investments in the stock market crashed. Everybody, lots of people lost money, and it was perpetual poverty throughout the country for years and years and years. It took us almost a decade to recover. What constitutes as thorough due diligence today varies greatly by the type of deal, the complexity of the deal, how long the company has been operating, and much more as far as it relates to the actual work and the costs that are involved. However, for early stage companies, it is really a process of fact checking or scenario outlining and modeling that's really put up against the investor or the creditor's risk or investment tolerance. So let me talk a little bit about that. If I say that I like businesses that are brand new, maybe they haven't generated any revenue before, my risk tolerance, meaning my risk for losing money and making this investment, might be really high because I know the statistics say that, what is it? I think 1 out of 10 tech businesses actually makes it and actually returns a return on investment. I think the Main Street statistic, I think, is one in 5 businesses, or maybe the opposite, 3 in 5 businesses fail within the first 5 years. So depending on what my risk tolerance is, I may be willing to take more risk because I'm looking for a bigger return when this business hits it big. Or I'm just trying to put in little amounts of money. I'm an angel investor. I'm putting in little amounts of money. I'm putting in the amount of money that I'm not afraid to lose, but I'm only looking for a smaller return. So all of these gaps of whether I'm putting in $1,000 or I'm putting in $100 million, they're all going to have some kind of due diligence process, whether you know it or not. And what that process is going to look like will be determined on how the scope and scale of the investment. However, early stage investors vary in terms of how much due diligence they want to do, to my earlier point. But some individual angels might do no due diligence. Maybe they've been a customer of yours and they just really like your product. They really like you as a human. They've seen you kind of take this thing from something to nothing, and they just want to invest in you. And maybe they'll get a return and maybe they won't. But groups of investor networks or angels tend to do a little bit more due diligence. And then obviously, when you're talking about a bank, they are going to do an extensive due diligence process. The reasons investors do due diligence is to convert unknowns into calculated risk. So obviously, they're meeting you. They know nothing about your business. So what they're trying to do is take enough information and be able to make a bet on your business. We can say, based on these things that they have put together that seem solid, we can, with some level of confidence, believe that they are going to pay us our money back or give us a return on investment. So why is due diligence even important, right? I think due diligence is important, like I said, just not for the investor, but also for the investee. It's a very valuable process. But specifically, it's important for two reasons. The first is it's the most effective way to get an A plus on your business. So if you're like me, you're a recovering type A and you want to hit it out of the park, you want to do a really good job, getting prepared for the due diligence process will make sure you're going to get that A plus. I recommend performing due diligence on your own organization and, quite frankly, your own personal finances every couple of years to get a clear picture of where the business stands. Where are the gaps that need to be addressed, especially if you're going to be looking for an investor within the next 12 to 24 months? The time to think about these due diligence questions is not when you need capital. I always say, like, think about you might have to go out and get capital tomorrow. So start preparing for it yesterday, right? And I've got a handy dandy checklist that I'm going to share with you a little bit later on. One key reason for doing due diligence is that it allows investors and other capital providers to evaluate your business effectively and ideally objectively. They're comparing you to other businesses like yours in the same time horizon, the same size, the same scale, the same industry. That's how they're going to be making some of the calculated risks. They're going to look at what's the industry standard and what are the things that we've seen that have contributed to successful businesses in that particular industry, and are you demonstrating those things, right? Investors assess your business based on several criteria that determine whether supporting the investment or supporting you fits within their goals as well as their guidelines. And investors, whether it's said or unsaid, they usually have some investment goals, whether that's return on investment, wanting to invest local, and what that percentage is, but also guidelines. They might have a guideline that says, I don't want to make an investment in a team that's smaller than 3 people. Right? They may not share that with you, but that is something they may not even know that themselves, but it's something that they carry in their head when they're looking and evaluating different kinds of businesses. Or they might be able to be thinking about, they're trying to answer questions like, will this company be able to pay me back? Can you provide a monetary return on the capital that I've provided? Or other questions. This evaluation applies to all kinds of different scenarios, including an investment, including a business loan or a bank loan of any kind, if we're talking about revenue-based financing or other kinds of financial structures, which we won't talk about, like convertible notes. We'll do that on another episode, right? But one of the things that you just really want to make sure that you're understanding as far as like why this is important, they're going to be asking you a lot of questions, and it's annoying. It's a really annoying process, and it can feel very like personal and that you're being attacked. But just know, anybody who goes through this process They're pretty much all asked the same questions. There are some questions that may pop up from a gender perspective that are inappropriate. There may be questions that pop up from a racial perspective that are inappropriate. And so the best thing that I can tell you is just be prepared. Not everybody has taken the journey to understand the biases that they're bringing to a conversation, whether it be age bias, whether it be gender bias. So you, as a business person or a person looking for capital, just need to be ready. Sometimes they're not conversations, good conversations. They're not pleasant conversations, but I will ask you to keep the objective in mind, but also think about, is this somebody you want to partner with? Because this is a matchmaking, right? I always tell entrepreneurs, you have just as much skin in the game as they do. And if you are finding that there's an investor that you're working with or a capital provider that you're working with, and you are finding it very difficult to work with them for whatever the reason is, understand that you may, if you get the investment, you're now stuck with this person for the terms of the investment. So really think about that. You may be getting into a 10-year relationship with this person if the terms of the investment are 10 years. It might be 20 years. So know that this process is just about much as you learning about who they are, how do they operate, what's important to them, what's valuable to them, what kind of companies have they invested in the past, what was the relationship of those businesses in the past. And then from there, really think about, is this somebody who I want to be in business with? Because they're asking the same question of you. You've been listening to Elaine Rasmussen. Coming up next, we're going to talk about what is actually the due diligence process for investment capital, whether you're an investor or getting some other kind of investment. You're listening to Do Different Better with your host, Elaine Rasmussen. We've just been talking about what is the due diligence process in trying to access capital and why it matters. Coming up, we're going to be talking about the 3 stages of due diligence. So, what are the 3 stages of due diligence? It is a screening due diligence, it is business due diligence, and it is legal due diligence. And we're going to go deep dive into all of those right now. So the first step is screening due diligence. The screening phase is almost always very informal, and sometimes it can catch you off guard. For instance, you may bump into an investor at a networking event like the Connect Up Summit. The conversation is flowing smoothly, and the investor seems to be really impressed by your business and what you're doing and all that you've accomplished that you've shared with them. Little did you know, they've already been digging into your social media presence. They've been looking at your website, and they've already started the informal assessment of whether or not you're worth making an investment in, or if they are interested in making an investment in you. Bear in mind that you should always be mindful of your image, particularly if you know that eventually in the next year, 2 years, 3 years, that you are going to be looking for capital. I'm not saying that is right or wrong, right? But be mindful of like what you're posting on your social media if you know that you're going to be looking for an investment. Some investors don't care. I don't know too many of those kinds of investors. Many investors will be following you on your social media. And if they see something that is out of alignment with their how they want their investment firm to be represented, or the portfolio of companies, or if they think that you might be a PR liability, they're not going to want to be associated with you, and they're not going to tell you the reason why. But bear in mind that you should always be mindful of your image because people are always watching. A wise investor once confided in me that they had been watching me for 2 years. 2 years. They had been reviewing my social media engagement. They had been attending some of my virtual webinars, and they had come to some of the events where I was speaking in person. So once again, at my first blush, it felt a little cringy, like, well, this person's been like stalking me unofficially. But this is what happens. This is just what happens. I'm not going to say whether it's right. I'm not going to say whether it's wrong. It's what happens. So you definitely want to be mindful and be aware if looking for capital in any sense is going to be something that's on your radar. Definitely be mindful of what kind of content that you are putting out there, whether it be personal content, content about your business, content about your competitors, content about your vendors. Those are all things that you want to be aware of. The next one in the process, or the next step in the process, is business due diligence. This is when the due diligence process moves into a more formal process. At this moment, the due diligence is being reviewed by some kind of organization. Maybe it's your financial institution because you're looking to get a business loan. Maybe it's an investor. Maybe it's a lawyer representing someone else, or an accountant or CPA. This is where it gets way more involved. It's an involved process, and this process can take about 30 to 180 days. It's really going to depend on the financial institution. It's going to depend on how eager the investor is to get in. It's going to depend on a lot of different factors. But know that you can always ask, how long is this part of the process planning to take? Right. And that way you can sort of gauge your energy and how you interact in the process, right? As opposed to going all in and putting in 150% upfront. And then it's 4 months later and you're like, I never want to talk to these people ever again, right? The part of the business due diligence is really let's understand it might be a lot of conversations. It might be video calls. They might ask for some kinds of documentation, not all documentation. At this point, you may want to request signing a non-disclosure agreement, or they may ask you to sign a non-disclosure agreement. That is not out of the realm of possibilities of things that can happen. And once again, you have agency in these conversations. And I say this particularly to our businesses, because sometimes the process can really feel like you're not in a position of strength. You're not in a position of power. But you 100% can ask why people are asking for what they're asking for. You can let them know that maybe a question that they're asking may be out of bounds or inappropriate. That doesn't mean that they will listen, but you have agency in these conversations, and I encourage you to explore them. Even if you're an individual and you're looking for a personal loan, you're working on getting a mortgage for a new home, you do have some agency in these conversations. So I know that the system is really kind of set up for this power play. You just need to do everything we tell you to do, sit down and shut up. But there is actually, you have agency and you can ask for different things. Doesn't mean that you'll get them, but you can ask for different things in the process, particularly why people might be asking you. And coming from a place of like a beginner's mind, I want to know and understand this process. The last step in the investment process is legal due diligence. This step is often intertwined with the first two, and really most often requires you to consult with legal partners and your own accountant on everything around the business entity, the operating agreements, your partner agreements, your articles of incorporation. Investors are eagerly looking at these required documents. Almost any due diligence process is going to be asking you for these documents. Prior to speaking with investors, it's wise to ensure that all the requirements have been met to avoid any unfavorable surprises. So if you don't have a partnership agreement with your partner, create one. Doesn't matter if the business has been operating for 3 years or the business has been operating for 10 years or 20 years. If you don't have a partner agreement and you're going to be looking for investment, create a partner agreement. If you don't have an operating agreement, create an operating agreement, because they are going to ask you for that. And if you don't have that, that's one more signal from their perspective that you are not handling your business. And if you're not handling your business, how can I trust you to handle my money? Okay. So also, this is the time when you and your legal team will carefully review any deal that's put on the table by the investor or the capital source. Make sure that you review the deal requirements and that they align with your business's capabilities and goals. So, and I'm just going to throw out something ridiculous. If in that agreement it says you need to have dinner with the investor once a month, every month in perpetuity, you might say, that's not something I want to do, or something I'm even able to do, because this is the weekend that I go visit my parents because they're getting elderly, right? I don't know, right? But This is why you want to read all of those details, even this fine print. And that's another reason why you do not want to DIY this. You want to have a lawyer who will go through this process with you and look for pitfalls. It seems simple, but it's a lot encompassed in these 3 steps. So I've broken it down into what I like to call the Dirty 30 checklist. But before we get to the Dirty 30 checklist, which we're going to talk about in the next segment, I really want to go back to this idea of giving you a tip. And the tip is, no matter whether your business is just starting or your business is 20 years old, I really encourage you to keep a file, a digital file, and a hard copy file of all the things that I'm going to be talking about in the Dirty 30 checklist, but particularly these documents that I've just talked to you about. So your operating agreement, if you're a corporation, your bylaws, if you are incorporated, your meeting minutes. I believe in the state of Minnesota, I may be wrong on this, but you're required to have at least one board meeting a year. And so you want to be able to have the meeting minutes. Even if that board meeting is just you, I had a colleague tell me this of like, you say, this is when we had the meeting, this is when it started, this is what it ended, this is what we discussed. Even as a single person, you're like, I talked about these things and looked into and had analysis around these things and made some decisions. Here's what the decisions that were made, even if it's one page, because you may have somebody, if you're looking for an investment, say, I would like to see the meeting minutes for the January 2021 board meeting, right? So if you're keeping all of this stuff in one place in a digital file, but also a paper file, right? Because they will ask for copies of these. I remember the days when these things had to be faxed, but you're not always at your computer. You're not always going to be in a digital space. So being able to have a hard copy and maybe have somebody in your office be able to, at the ready, send this information to whomever is requesting the information, that's great. There's some really great platforms nowadays where you can actually keep all of this in what's called a data room. A data room is a secured digital space where you can keep some of these highly sensitive documents that you wouldn't want out on the web. What's nice about some of these data rooms, and I think there's DocuSign, there's DocHub, there's Adobe, there's lots of places, resources, and some of them are free or low cost that you can start to create a data room of what I call like organizational documents. I call it an organizational book, and you can put all these documents in there. What's really great about some of these platforms is you can send something to somebody and say, let's say it's your partnership agreement. And let's say you've been asked by the bank as you're pursuing a $100,000 bank loan, and you're going to be sending this over to your loan officer, your business loan officer. In these platforms, you're able to send that document to them, and you can even limit how long they have permission to open that document. So if you wanted to send it to your banker, let's call your banker Kenya. I'm sending this document over to you. This document can be opened for 7 days, and then that permission is now declined, right? It has an automatic shut up, or you can say 14 days, or you can say 21 days. You can even ask your loan officer, hey, Kenya, how many days do you need access to this document? And then you can set it up for those, however many days those are. What's really great about that feature is you can set it and forget it. You can say, I'm sending this document. I want to give permission to this document for X amount of days. Once those days have expired, it will automatically turn off the permission to access that document. That's a really powerful tool because you're in business, you're running around doing all the things. What you don't have time for is to be document managing, right? So, but what's also great about this is everything's all in one place. You never have to think about it. And I really encourage businesses, particularly around your financial statements, have a folder in your data room that's just your financial documents that you're uploading every single quarter. That could be, if you're working in QuickBooks, you can have QuickBooks send you a reminder or send you a report, your profit and loss statement, your cash flow statement, your balance sheet. You can set up QuickBooks to send that information to you every month on the 1st, on the 5th, on the 10th. Whatever day you want, you can have it sent to your potential investors. You can have it sent to your banker, and they will not have permission into your QuickBooks account. They're just sending a report that comes from the account. But you can also, once you get that report, upload it to your data room. Now you know that you are keeping your financial documents up and running or up and uploaded throughout the whole entire time of your business. So, and coming up in the next segment, we're going to take a deep dive into the Dirty 30. You've been listening to Do Different Better with your host, Elaine Rasmussen, and we'll see you in the next segment. You're listening to Do Different Better with your host, Elaine Rasmussen. We have been talking about the due diligence process in accessing capital for your business or other investment purposes. Coming up next, we're going to be talking about my Dirty 30 checklist. Why I call it the Dirty 30, what is it? And I think this will give you some really great insight on how best to prepare for business capital and, quite frankly, any capital. These are going to be some really good tips that you can start to self-reflect on. So, why do I call this list the Dirty 30 checklist? This checklist, and almost anybody who's providing capital will have some sort of list. I even had one person say to me, "I've got 90 questions, Elaine." And I'm like, really? Do you really have 90 questions? I don't know that you need 90 questions, but these 30, I'm going to guess he's got 90 questions, but they can be distilled down into these 30. But these are definitely the most critical things. And then there might be some things on top of this based on your industry. So these are just sort of baseline things, no matter what your industry is, no matter how big or how small your business is. These are questions that you're going to want to feel comfortable about. These questions get you into the mindset of the person who has the capital, who might be investing in you. This includes your finances, your team, other creditors, your lenders, your other investors, all of the things, your strategic partners, your vendors. And it's a good idea to talk about these things in advance so that you can really answer these questions well. And if you have a partner or partners, start to think about, can you do divide and conquer? Can each one of you be experts on a certain particular aspect of the business? Having somebody be the expert on sales, have someone be the expert on the operations. So while you kind of know everything about the business, but these are the people who kind of know the data, the details, the statistics, the trends, all of that, those things, those nitty-gritty things. Because once you get to the business due diligence part and the legal due diligence part, those questions will definitely come up. I call these questions the Dirty 30 because they require a fair amount of effort to confidently answer, right? Think about if you've ever done public speaking. This is, for me, public speaking on like 100, even though there's maybe one or two people in the room, they're asking you about like everything about your business, and it can quite feel invasive. But I call it the Dirty 30 because it's kind of like tackling a heap of smelly, dirty laundry. Like, really, it takes a lot of work to get through these, but it's not pleasant, right? But it's got to get done because you want some clean clothes, right? But this process is super, super important. And business owners, I cannot tell you, avoid this crucial task. And like I said, this is a great exercise, whether you're looking for capital or not, for you and your partners, even your employees, to really think about, can you answer these questions, and what questions can't you answer, and why can't you answer them, and create a plan to be able to answer them and answer them well. So when you're seeking capital, investors will inevitably pose questions that typically fall into 6 categories, right? I'm going to name the 6, and then I'm going to go deeper into each one. The 6 categories are your product or service, whatever is the thing that is your business that you make or do. The company structure and the history of the company. How did this company come to be? Did it come out of because you saw that there's a gap in the marketplace? Did you create this company because there was a problem that you needed to solve that you didn't have a solution for and you couldn't find a solution? Whatever those things are, is it that you inherited the business? Is it that you and some friends came together in college? They really they want to know that story, and they want to know, like, what have been the bumps in the road that you've had to tackle. Leadership and the team, it's all of your team members and the expertise that you've called, whether it be your advisory, you might have an advisory group, you might have a group of peer mentors, you might have an unofficial board of directors, right? They're going to want to know, what are the resources, human and otherwise, you have at your disposal. So if you get stuck, they're not always going to be an investor that wants to be part of your business. They might be a silent partner. There might be, I'm only investing money only. I don't need to see you. I don't need to talk to you. But that's why they're another reason why they're asking you all these questions, right? They want to know that everybody on the team has got the expertise that it needs in this particular industry to get the job done. The next one is financials for all the obvious reasons. They also want to look at your sales. They want to look at what's your growth plan, how have you been growing historically, and where are you looking to grow in the future. They're also going to ask you about your production and your operations, right? So how much are you producing? When are you producing? How much does it cost to produce? The cost of goods sold. I can't tell you how many entrepreneurs cannot tell me what their cost of goods sold. They don't even want to think about the calculation of calculating their cost of goods sold, but it's a really important number. It's a really important pivotal number. But they're also going to ask you about the operations. How many employees are there? What's been your turnover? What's your retention rate with your employees? Are you churning out employees every 3 months and they're leaving? What's happening? Is that a problem with management, or is that a problem with geography? Like, what are some of the issues, right? And then intangibles, right? So going back to what we talked about, remember when we talked about screening due diligence and we talked about your social media and what could be out there? So I'll tell you a quick story. This has nothing to do with investing, but just to tell you the power of like how social media can impact a person's perception of you, particularly in an exchange of money. So this was a couple years ago, I had hired a contractor to come on to manage some communications. We were doing some big events and we hired this person to do a lot of our public relations work. So I'd asked this person, I'd vetted this person, I'd interviewed them a couple of times. They were referred to me by somebody who I highly trusted. This person had also worked for this person who I highly trusted. So I thought, listen, I know that this person who has referred them to me is a tough bird. I know that if they can work for this person, they can work for me. So we're going through the process. And before I wrote an offer, I went on social media and I saw some pretty concerning things about this person. So when they came to see me to sit down to talk about the offer letter, I was still going to offer them this opportunity. But I said to them, I am offering you this opportunity, but I think it's important for you to know that there is information about you out on the internet. And I printed out the things that were being said about this person. I said, these are things that people are saying about you. One of the reasons why I am going forward with hiring you is because what I'm seeing here has not been my experience of you. And from what I understand from this person who referred me to you, that is not their experience of you either. So I want to give you the benefit of the doubt and go forward. Now, eventually I ended up firing this person, not for any of the reasons why what I saw on social media. They actually just didn't do the work, right? But that is just an example I wanted to illustrate to you of like how your social media can work for you, but can also work against you. So being mindful, once again, I'm not saying that it's right or it's wrong. I'm just telling you that people will be looking at your social media and make decisions around whether or not they want to partner with you, whether or not they want to work with you, whether or not they want to hire you. And so just to be mindful of that, just be thoughtful of that. But now what we're going to do is we're going to go into each particular one, right? So we are going to go into each one of these categories, and I'm going to talk about some of the questions that will come up in that particular category. So the first one is really the questions around your goods and your services, right? So these are going to be questions about like your company name. Have you trademarked your company name? Have you trademarked your logo? What products or services are you offering? What does the market look like for those products and services? They're going to be asking you about what are the company's values? What do you stand for? And has there been a time where you found that your company values were compromised, or your company values led you through a decision that you had to make, right? They might ask you, have you got your domain locked down? Sometimes you might be, especially if you're a tech business, you might be going to get capital before the business is even up and running, right? So they're going to ask you things like, do you own the domain? Do you own the social media channels? Have you done your due diligence on your own intellectual property? I can't tell you how many times I've heard from investors of like, they didn't even Google their own name to find out that there was a whole nother company that had a similar name or the same name in a market or in an industry that's very, very close, right? So then what does that mean? That means when you go to file for copyright or when you go to file for trademark, if there's another name and it's in an adjacent market, right, or an adjacent industry, you may not get your submission, you may not get your trademark approval, because what the trademark office looks for is, will this confuse the customer? If we have these two companies that are close in the industries that they're in, maybe one is a cleaning supply company and one is an actual a cleaning they do cleaning of offices, and they both have the same name of Squeaky Clean Cleaners. One of them may not get their name because the trademark office is looking for, will the general public be confused by this? And there's a good likelihood that they will, right? They're also going to be asking things as it relates to your company's goods and services. How will you make the money? How will you make money? And we'll talk a little bit more about that sales, but they're thinking about conceptually, what's the business model, right? How will you go? Are you going to be looking to grow market expansion? Are you going to go through product expansion? Are you going to go through creating efficiency and effectiveness in the product that you deliver or the service that you deliver? How are you going to grow that business? And what is your strategic advantage? Is your strategic advantage that, hey, I've been dealing with this issue my whole entire life. No one knows this problem better than I do, right? Or is your strategic advantage of like, hey, I inherited a whole warehouse, so I have free rent for the next 10 years, right? I don't know, but you need to have thought through some of these things as you're thinking about talking to a potential investor or bank officer that you're looking to get money from. The next section is going to be about company structure. So what is the entity type? Are you an LLC? Are you an S Corp? Are you a C Corp? Are you a benefit corporation? And a benefit corporation, we've talked about in the past, is a corporation who is mission first, right? That doesn't mean you don't make a profit, but if a situation arises, the priority is mission over profit, right? But you are still seated with wanting to have the organization profitable. They're going to look at, where is the company located? Are the conditions, the external conditions, favorable for your kind of business in that particular market? So I'll give you an example. If you are looking to build container homes and you are looking to sell them in the northern Minnesota market, and you are looking for an investor of $1 million, an investor might say, if your market is northern Minnesota and we know that containers only have a certain rating for certain weather, this doesn't seem like it's a good business model. What you're producing for the market you're going after doesn't seem to make sense. So now I have questions about whether or not you know what you're doing, as opposed to, hey, we're headquartered in northern Minnesota, but our distribution and our main customer base is south of Oklahoma, right? The Southwest or the Southeast. We're selling container homes to geographies where the insulation rating is best suited for this particular product. So those are some of the things that will come into play. They're also looking at, so will this company be public or will it be private? You may have heard the term IPO, which stands for initial public offering. It's when a company goes from being a privately held company to then going to be public, meaning shares can be sold to the public on the stock exchange, right? What is your plan for the business? Is your plan to stay private, and which is completely fine? But then that means their investment has to be structured in a certain way, and that may not be of interest to them. As opposed to, if you're going public, they're looking for a 30x return on investment. If your plan is to go public, that may better align with what their investment goals on. Now, once again, this is going to depend on the individual. Every individual investor, every bank, every organization that has capital, that moves capital, has an objective, and you want to be clear. And you can ask, what are your goals? What are your objectives if you make this investment? What do you need to have happen? What kind of return on investment do you need to have? What's the timeline you need to have? And some of those things are negotiable, but going into the conversation, you want to at least have an understanding of what perspective or where they're going to be coming from. Okay. So some of the other things that they might ask you, like, how are you managed? How is the company managed? Do you have? I know what's coming very popular is co or decentralized management or multiple management heads. So I've seen a few organizations have three CEOs, and each CEO is responsible for a specific aspect of the company. So it could be you can have a CEO that specifically works on operations. You can have CEO that mostly works on production. You can have CEO that deals with strategy and external partners, right? So you can divvy those up if you're in a family business, right? And there's multiple family members who might be in the business. Those are also things that you can start to get clarity about. So if the company is looking to get an investment, you want to be able to say, hey, my uncle does this, my aunt does this, my sister does this, my daughter does this. And that way you're giving a clear picture of here's the management and the organizational chart of who's responsible for what. That will give your capital partner a lot of confidence. Do you have a physical location? Are you stretched beyond capacity in the current location? Are you looking for a location? And what is getting a location look like in the current market where you are? Or are you going to be looking to go overseas? Are you looking to move the operations to someplace else? What are those pieces? And they also might want to know, have you previously owned a business and what happened with that business? Now, you may think it's none of their business whether or not, but obviously, if you've done well, you would want to share that. Maybe if you didn't do so well, you might not want to share that. But here's how I would encourage you to position it. They may ask you the question. I'm sure they will ask you the question. But when they ask you the question and you have experience running a business and it didn't go well, use it as a position of strength. You can say, hey, I ended up having to close the doors. These are the reasons why. I learned so many lessons from that now I've taken those lessons into this business and I don't plan to repeat those mistakes. It was a very painful experience. And now I feel like I know what I didn't know to ensure the success of this business. So you can turn it around, right? What do they say? Turn that frown upside down. You can use this as an opportunity to be able to turn the situation and leverage from a place of strength, right? So those are just few of the questions that might be asked, right? Now let's go into company leadership. So once again, they're going to ask you, how has the ownership been held up to that point? Is it recorded? Meaning, have you filed with the Secretary of State? Who has an ownership stake in the company, right? So if a company has a partnership, whether that be spouses, whether that be siblings, whether that be friends, they want to know what's the stake of each particular person. Because as they invest, if they are getting an equity position, right, which is a piece of the ownership, they're going to want to know who is the ownership going to come from, right? So if, let's just say for math's sake, you've got four people in a business, each of them owns 25%, right? If an investor is coming in and they want 20%, then each one of the other four people's got to give up 5%, right? So the investor is thinking about, how many people am I going to be in business with? What are their stake? Now, let's say somebody's a silent partner, they put in an investment and they're in name only. They're going to want to make sure that that's recorded somewhere. So these are some of the things, like they're also going to know, like, how much has everybody invested, meaning whether they're your partners, whether they're your spouse, who actually runs the company and what are their traits, going back to the company information. They're going to ask, are there employees? How many contractors? And what is your plan for technology and creating efficiency in the organization? What tech platforms are you using? Are you using a customer relationship management system or a CRM? Are you using digital tools? Are you on social media? Are you not on social media, right? And how do you leverage social media? The next section is about company finances, right? So this is where they're going to be asking you, we need the last 2 years of bank statements. We need the last 2 years of your year-end balance sheet. We want balance sheets every month for the last 24 months. We want to see cash flow statements every month for the last 24 months. There usually is, depending on the size of the investment, a minimum of a 2-year look back. So they're going to want to go into your records. They're going to want records from you from the last 2 years. So that could include, but not limited to, bank statements, profit and loss statements, balance sheets, um, all of the key financial statements they might asking you for, right? The last one is the company legal support. So they're going to ask you, like, once again, do you have insurance? Do you have a lawyer? Do you have an accountant? What's your marketing plan, or any of these things written down? So I know this was a lot to cover, but you can DM me on social media at Social Impact Now on IG or Facebook, and I'll be happy to send you the Dirty 30 checklist of all the questions you need to be able to answer about your business. Now that you know what the process is, it's time to get to do the work. After answering all these questions in the due diligence checklist, you'll be well equipped with the information you need to speak with investors or other potential sources of capital with confidence. The checklist here ensures that you have mostly everything covered, and that will give you a solid presentation. Well, that wraps up another episode of Do Different Better with your host, Elaine Rasmussen. We talked about due diligence. We talked about the process for getting ready for capital, whether it's right for your business, for a partnership, or for anything else. We've discussed how what it entails, how long it takes, and why it's so crucial for accessing capital. We also discussed how to identify the gaps in your business that you need to focus on to navigate the due diligence process successfully. I can't wait for next week's conversation. Join me next episode of Do Different Better with Elaine Rasmussen. I'll have some special guests joining me. Tune in to find out who they are. Let me know what you think of the show. We love comments. So tell us how this show has helped you. If there's a money or finance question you have, or there's somebody you want me to interview, hit me up on LinkedIn, Instagram, or Facebook. And don't forget to hit the subscribe button and follow us on all of our socials. Stay tuned, and I will see you next week when I will show you how to do different better.